Hello. So, a couple of years ago, I made a video on how to develop an understanding about the financials of a business by reading a one-page value line report. And I used Google as an example. At that time, the share price of Google was around $100. Now the share price is $160. So in 2 years, the share price has increased by 60%. This is very good, actually. Now the idea behind that video was to talk about how to start developing an understanding of a business and how to value a business like a financial analyst. Here's that video again, but bear in mind that this video is 2 years old. So in this video, I will talk about how to develop an understanding of a business by looking at the one-page report prepared by Value Line. I will use Alphabet, commonly known as Google, as an example. But remember that it takes practice to get better at understanding businesses, and by practice I mean you would have to look at and analyze several reports and businesses to improve in this area. And like anything, the more you practice, the better you get. So Value Line is an independent investment research and financial publishing firm based in USA. Value Line prepares regular reports for many publicly owned companies, and its reports are one of the best I've seen. They're sharp, focused, and to the point. But before looking at the Value Line's report, let me ask a question. How do you value a business to decide whether you can buy its shares or not? How do you do that? Now, there are various valuation methods, and in this video, I will just focus on the basics. Well, the first thing will be to not think of a business made up of shares, rather look at the entire business as a whole. So do not think of owning a few shares of that business, but think of owning the entire business as a potential business owner. This type of thinking will make you more inquisitive and cautious and curious. So what does Value Line's one-page report tells us about a business? It provides a summary of the business. It tells you the market cap, number of shares outstanding, share price at the time of preparation of report, price to earning ratio, and other relevant financial information. And you can use this information to quickly understand the business. And this one-page report gives a very good snapshot of the financial situation of a business. It has almost everything I need to see in 2 minutes to decide whether I need to look deeper into the business as a potential buy or discard it and move on to the next business. Now, most of these one-page reports are available for free from Value Line if you sign up. In other cases, Value Line may require you to pay a subscription fee to access these reports, and you can download these reports by going to the Value Line website, logging in, and then clicking on the PDF report link to get the PDF version. Now the things I would look at are the market cap, revenue, operating margin, net income, debt, return on equity, return on capital, summary about the business, and PE ratio. And then I will try to make some sense of these numbers. So let's make a start. The market cap of Google is $1.4 trillion as of 30th September 2022. This tells me that this is one of the biggest companies in the entire world, maybe in the top 5, along with Amazon and Microsoft. Now, Alphabet or Google has 3 types of shares: Class A, Class B, and Class C shares. Class B shares are for the founders, and Class A and Class C shares are for regular investors. And this one-page Value Line report is for Class C shares, with the ticker GOOG. The financials of the company will remain the same whether it's Class C, Class B, or Class A shares. I don't pay much attention to the share price because it doesn't tell me anything about the finances of a business when I start looking at the Value Line report. So I tend to ignore the share price at the start. Now let's look at the revenue of Google. Revenue is over here, so just a note that for these numbers, let's say the revenue in 2021 is $257,637. What this means is that the actual revenue is $257.6 billion. So you just need to multiply these numbers with million and you will get the actual revenue. So the revenue in 2021 was $257.6 billion, and that's massive. And in 2020, it was $182.5 billion. And in 2019, it was $161.8 billion. So from this, what I can see is that the revenue has been increasing year over year. So that is a very good sign for the business. Now this means that the business is making money every year and the sales are improving, or the sales are increasing every year. So this is really good. Now let's look at the operating margin, which is just beneath the revenue. The operating margin in 2021 was 35% in 2020. and it was 29.7% in 2019, and again 29% and so on. So by looking at this trend, you can see that their operating margin is in late 20s, early 30s, 29, 29, 31, 35% in 2021. So that's really good, meaning their operating margin is also very consistent. Now let's calculate the operating income quickly. So the operating income will be operating margin multiplied by revenue. So let's do it for 2021. In 2021, the operating income was 35% multiplied by 257.6. This will give you approximately $90 billion. So the operating income in 2021 was $90 billion. Now note that this one-page report prepared by Value Line does not account for depreciation when calculating operating income. But I want to include depreciation because I think it's a key thing to consider. So after depreciation, the depreciation in 2021 was $11.55 billion. So after depreciation, which is underneath the operating margins, deducting 11.55 from 90 gives me $79 billion of operating income. So that's the operating income I will look at. Let's look at the working capital now. So the working capital in 2021 was $123.89 billion. You can also calculate the working capital if you want by looking at the current position table, and it's just the current assets minus current liabilities. So in this case, it will be 188 billion minus 64.2 billion, which will give you the same $123.8 billion of working capital. So the reason I wanted to calculate operating income was because I wanted to look at the working capital to see how much income, how much operating income Google is generating from this deployed working capital. So in this case, $124 billion of working capital or deployed capital is generating around $79 billion of operating income. So you can say that the operating income is approximately 63% of deployed capital. So this is massive actually. This is really, really good. So this is not a bad business at all because deployed capital is earning almost 63% in operating income. That's really good. And if I look at the book value, I see that the book value is pretty clean. And it consists of tangibles including working capital. So this looks like a very good business and merits further investigation. Now let's look at the net income. The net income is this net profit over here. The net income in 2021 was $76 billion. In 2020, it was $40 billion. In 2019, it was $36 billion. So you can see that the net income is also increasing year over year. So that's pretty good. And looking at the net profit margin, which is also known as the net income margin, the net profit margin is 29.5% in 2021, 22.1% in 2020, 22.3% in 2019. So this Value Line one-page report gives data starting from 2012 till 2023. So almost 10 years of data. So what we can see is that the net income is increasing year over year. So the trend is that the revenue is also increasing, operating income is also increasing, and the net income is also increasing. So this is very good. The net profit margin is hovering around 20 to 22%, which is really, really good. What this means is that for $1 of sale or $1 of revenue for Google, Google is earning 20 cents in profit. So that's pretty good business. Now let's look at the return on capital and return on equity. Now what these tell me is how efficient a company is in deploying its capital and shareholders' equity to grow the business. So return on capital in 2021 was 28.6%. In 2020 and 2019, it was around 17%. So it's hovering around 17 and 18% except for a big jump in 2021. So what this tells me is that for every dollar of capital invested in the business is returning 17 or 18 cents. So that's pretty good business. It requires little capital to generate money and profits. And this is the reason why I pay attention to return on capital. Now I will look at return on shareholders' equity, which is 30.2% in 2021. It was 18.1% in 2020 and 17.9% in 2019. That's also pretty good. But obviously, there's a big jump in 2021. In fact, there's a big jump in 2021 for revenue, operating income, net income, and return on capital and return on shareholders' equity. Now, to find out why there's a big jump in 2021, what I would do is I will read the financial statements, listen to investor relations call, and do some investigation. And this is because I would need to understand the reason for this big jump in revenue in 2021 and whether that jump was a one-off jump or will the business continue to grow like that. So now let's look at the debt. Google doesn't really have much debt. Its long-term debt is only $14.6 billion in 2021, or as of 30th September 2022. That's nothing compared to the shareholders' equity of $251.6 billion in 2021. That's actually really good. I will quickly calculate the debt to equity ratio just to see what it is. So 14 billion divided by 251.6 gives me 0.06. So debt to equity ratio is 0.06, which is really nothing. And this is very small. Normally, big companies carry a lot of debt on their balance sheets so they can grow their business, but Google does not, which is very good to know. This means that Google doesn't need debt to grow its business, and this is very important to understand. And historically, I don't think Google has taken much debt to grow its business at all. So that's pretty good. So Google is a well-known company. So I will probably skip this business summary over here because I already know what Google's business is. But for other companies, if I'm looking at the one-page value line report, I will pay attention to the business summary because it tells me a lot more about the business and gives me a good understanding about the business. So another thing I look at in this value line report is the PE ratio, which is mentioned over here, or the price to earning ratio. Is 19.7. So if the PE ratio is low and the business is doing great, like we have determined because the revenue is growing, net income is growing, returns are really good, profit margin is really good, then what this means is that the share price is reasonable in my view. But if the PE ratio is very high, such as it's 50 or 100 or 200, then the business needs to grow significantly more in future to justify its high PE ratio. So that's how I look at PE ratio when I am trying to understand a business. Now, for most businesses, you need to check if they are able to pay their long-term debt and short-term liabilities. And for some businesses, you don't really need to pay much attention to it. For example, businesses like Apple, Google, because their balance sheet is so strong and healthy, they can carry small debts and they can pay off their short-term liability fairly easily. You can quickly check that they are more than able to pay off their debts. But for other companies, you need to pay attention to whether they are able to pay off their long-term debts and whether they are able to meet their short-term liabilities or not. Now that I have determined all this in a few minutes, that I have looked at the revenue, I have looked at the operating income, net income, I've also looked at the operating margin, net profit margin, and the returns, I can now spend some time on Google's business and look at its financial statements and listen to investor relations call to better inform myself whether I should buy this business or not. If these numbers, if the revenues, operating income, margin, PE ratio didn't make sense to me, I would just discard this business and I would not go and look at its financial statements. But if these numbers, revenue, operating income, net income, operating margin, profit margin, returns, if they didn't make sense to me after reading the one-page value line report, I will not go ahead and I will not look at the financial statements of the business. But in the case of Google, these numbers make sense to me and I really like these numbers. So I will like to read the financial statements and listen to investor relations call to better inform myself about the business. So this 2 minute of quick analysis from the value line report tells me a lot about Google and its business. In this case, it tells me that it is a really good business and needs some further investigation for me to make a decision about it. I will look at the various revenue streams of Google if I need to investigate it further. The revenue might be coming from Google Ads, YouTube, Pixel Phone, Google Cloud, Google AI, and some other revenue sources of Google. And I will use financial statements to understand all of that. Then I will calculate intrinsic value of Google using discounted cash flow method to see whether the business is cheaper than the current share price or not. And you don't always need to do a DCF analysis. Most of the time, you can make a decision just by reading the financial statements and making sense of the numbers. But DCF is a good tool to learn, and in some cases, you may want to use it for your decision making. So that was it. Hope this was useful. Have a great day. Thank you. Cheers.